We've got a distinguished panel here to talk about REIT M&A, comprised of some senior bankers and CEOs. Scott, is there still such a thing as REIT M&A? I mean, are we on the crest of a new wave? Are things really getting busy, or are people busy getting their houses in order?
Things are definitely getting busier, but as my 10th grade history teacher taught me, history doesn't repeat itself, but it rhymes. And so we're in a situation that's a little parallel to the 90s. It was great when we started, right after Kimco and the birth of the era, a lot of very well-capitalized companies. That's where the money was, and that's where the value was. And so if you were maybe underwater on your debt, you can go to the public markets. And it was great to watch all that grow. And we had a lot of fun in 05 and 07 selling a bunch of those companies to the Blackstones of the world as the value became greater in the private markets than the public markets. So now we're back in this situation where a lot of folks are looking at tapping into the public markets. The capital is there for the public companies, and we're in a different feel, though, than we were in the 90s. In the 90s, we had 0 REITs in the S&P. Now we have 12. In the meantime, we've gone from 153 public companies to 115. So we've had a shrinkage of the number of companies, fewer choices for investors. So now what we're focused on is really a lack of targets. And so I think what people have been asking is, when are we going to see RTC version 2.0? And we're not seeing it yet, and you just heard the panel before us talk about that. But we are starting to see stuff come loose, and I think that we will see more properties coming on. I said to one of my clients who was looking at a portfolio, we were trying to do this A-B structure on the debt, and he said, you're having trouble making the math work. I said, don't worry, there's another $1 trillion worth of this stuff right behind it.
Great. Turn from Scott to Scott. Scott Eisen, do you agree? Do you think that we have haves and have-mores, or are there, have we started to separate out between the stronger players and the weaker players, or is everyone that made it through relatively healthy, and it's a situation where we're waiting for opportunities to arise?
Well, first of all, Scott Shavitz stole my line of the haves and have-mores, so I have to come up with something more creative to say here. But look, the reality is, when you look at the FFO multiples of the REIT sector today, it may seduce some people to think that there is an opportunity to do public-to-public M&A. You've got the highest multiple REITs trading in the 15 to 20 times FFO category, and the lower multiple REITs below 10 times FFO. But the reality is, even the lower-rated, lower FFO REITs still have substantial access to capital today. It's more expensive, but the liquidity is there. And that's why people use the expression of the REIT haves and have-mores. When you think about the bond markets today, the best, most well-capitalized REITs can raise 10-year money sub 6%, but some of the lower-rated REITs can still raise money inside of 8%. The best capitalized REITs can raise perpetual preferred in the 7s, and you've seen some recent preferred trades for some of the less well-capitalized companies happen in the 9s. Look, at the end of the day, to do perpetual preferred money, even with a lower-rated company with a 9% yield on it, is still pretty attractive cost of capital when you think about what is available in the private markets and what liquidity some of the private companies have today. Look at the entire REIT sector. The sector, on average, trades at about 120% of NAV. I know there was a lot of talk today. I think Mike Kirby at one point made a comment that they can't keep up with how quickly they see cap rates dropping in the environment today. Within the last 60 to 90 days, I think Dave Henry said earlier he's seen shopping center deals drop from a 9 cap to a 7 cap. So you have some very rapid readjustments of cap rates in people's NAVs at this point in the cycle. But even some of the lower multiple REITs in the sector today are still trading at a premium to NAV. So to say that there are haves and have-nots is not really that accurate. And frankly, for a lot of the public companies, whether they're in the have or have-more or have-not category, there's probably still more attractive M&A opportunities on the private side.
When are we going to start to see activity again? The money is there, or is it a situation where people are going to wait for the deals, or are people going to start chasing things at prices that don't make sense?
People will follow the opportunity, and right now the opportunity is on the private side. And just as Scott said, if you look at the public companies today and where they trade, public-to-public REIT mergers are difficult to justify the premiums unless there's synergies there that can explain why you're going to pay for those premiums. On the other hand, the public companies have tremendous liquidity, and they're looking to the private sector where there's little transaction flow right now, but they're waiting, and they're saving their capital to take advantage of what they hope will be RTC2, as somebody else said, or when the transaction flow finally breaks loose from the banks.
You know, it's interesting, if you look back to what I think was the first meaningful public-to-public REIT M&A transaction in the mid-90s when Simon merged with DeBartolo. That signaled what was, for the most part, I think for many of us, most of the real estate M&A involved public target, public acquirer. That changed pretty dramatically over the last 5 to 7 years, and that has been picked up in much of the commentary earlier, largely on the back of very well-priced leverage available. And you first started seeing private capital sources teaming up with strategic buyers, and by the end of the peak of the cycle, you had entire leverage buyouts being completed with real estate targets with 100% private capital and very high leverage levels. What's interesting as we look forward is I do think it will change, and what we haven't really seen on a large scale until now is the impact of restructuring or reorganization transactions. There was a lot of talk at lunch over General Growth. I think there's currently a bankruptcy case going on involving extended stay. There's a large transaction here in New York City involving Stuyvesant Town and Peter Cooper Village. And what is visible in those situations, and for GGP, you really have to go back to when things had bottomed, it was not clear initially where value would reside within that capital stack. And I think a couple folks have observed the stock was trading for pennies. So the suggestion was that value for the enterprise resided somewhere probably in the unsecured, roughly $7 billion capital stack. What I'm driving at is there will almost certainly be a meaningful amount of activity ahead of us, but control in many cases may be derived in less typical fashion. I think we're going to see players increasingly employ techniques used in the distressed world to perhaps control portfolios or companies with stress or distress by playing in the credit.
From an M&A standpoint, from our perspective, it has to pass what I call the non-fat decaf cappuccino test, which is why bother. And there's not a lot of number one. If you look at the implied cap rates that most of the companies are trading at, there's not a lot of difference, so to speak, between the top of the food chain, say Federal, and the bottom of the food chain, companies to go unnamed. And then secondly, you'd have to pay a premium. So I don't know that it's going to make sense from what's the strategic rationale to make the investment, and secondly, are you going to be paid economically for making that investment? And from our standpoint, there's very few opportunities out there, very few publicly traded companies, very few, where in effect we think it wouldn't be dilutive to the quality of our portfolio. So we don't spend a lot of time, and those companies, they're not for sale, or they trade at and rightfully so, trade at very high or lower implied cap rates, and deservedly so. So we don't spend a lot of time thinking about, because of that, because it just doesn't seem like we can wisely deploy our capital or use our precious stock in a way that's going to make sense for our shareholders.
The area of opportunity that I see is, given all of what I've just said and all the things you heard today, is probably more in the private market in the area of what I call elegant solutions for private sponsorship. There is no question that there's an extreme over-leveraging today of many portfolios and legacy companies that have been successful through the years in building teams, building their good name in the marketplace, got caught up in the wave, made good investments, sold at the high point, and then made the mistake because nobody could have known how severe this downdraft would be of reinvesting those proceeds at what ended up to be the peak of the market. And so those, many of those, or those that I've spoken with, find themselves in a situation where they have looming debt maturities with almost no one to talk to, other than perhaps the special servicing community that perhaps has different motivations for keeping loans in place and really, in many instances, can't be part of the solution. They have equity participants, the sponsorship, and other equity participants that may be out of the money now as a result of the downdraft in valuations and the fact that NOIs are deteriorating, in my view, at least in my food group, in the office sector, given the lack of job vibrancy, will continue to deteriorate over the next couple of years. They need solutions. They have tax issues, potentially, that the REIT industry can solve through the issuance of OP units, and they need our capital at this point. Otherwise, they face very difficult decisions in the future. And so I think that you will see public companies being part of what I'm calling elegant solutions moving forward. These perhaps don't have the scale where an IPO would be something worthy of consideration. And so I think perhaps, and the difficulty and expense of execution would take that option off of the table. And maybe some of the private equity funds, some of whom have participated in these discussions today, their return expectations are just too high. Their money is too expensive to be part of some of these solutions.
Are you hearing from the buy-side guys, and over history, have you heard, they don't want 30 REITs, right? They don't want these mega REITs because they need to be able to beat the index, right? They need to be able to choose amongst companies.
Scott, I often hear that, if we want to pick a market, we'll pick a stock. If we want to pick a sector, we'll pick a stock. And so I think that is part of it. There's been a trend through the public over the last decade and a half of what is really the new era of REITs, of equity REITs, where specialization, super-regional REITs, market-specific REITs have been much more popular, at least with respect to the core REIT investors. Now, maybe that will change as this massive deleveraging is going to continue to occur in this economy over the next 2 or 3 years.